argue this and say, well, I long-term invest, let's say in the stock market.
Right.
I put my money in every single month, and 30 years from now, I will have all of this gain on that. Yes, you will, but none of that money that you're putting in there is doing something with something else, is creating a new thing. You're just dumping it into this one and frankly making a long bet.
Right.
Maybe it's a conservative long bet, but it's a long bet.
Right.
Whereas if you can, even if it's a small amount, whether it's real estate or otherwise, pulling that out and then going after another, pulling it out and going after another, you're constantly taking this, what I like to call the engine of your capital, and making that engine work for you, which is making money work for you as opposed to working for the money.
Right.
Well, hello, Steve.
Hello, Steve.
How the heck are you doing?
Today I'm doing terrific.
Fantastic. Welcome to the Steve and Steve Show.
We should thank everyone for watching.
Yeah, in these interesting times, right?
Yep.
Some would call crazy.
Yep, definitely. So thanks for watching. And if you're new to us and just discovered us, absolutely thank you for hitting the play and turning up the volume. To do us a favor though, hit subscribe, because we could use all the subscribers we can get at this point.
Yeah. Tell your friends, family, acquaintances, everybody you know to go and subscribe. We found actually that, I don't know why, but if you search in YouTube Stephen Wastenberg, it actually comes up with the Steve and Steve Show. If you search your name, other things come up. Yeah, that are not the Steve and Steve Show.
That's because I've been putting I put both of our names in there, but
well, my name's kind of unique, whereas Walsh is, Joel Walsh, and so Wastenberg, Wostenberg.
There are at least two Steve Walshes that are a little bit more famous than I am.
Yes. Yep.
But that'll change.
That will soon.
My time is coming.
And you all can help us with that. We're not seeking fame nor fortune. We're trying to teach it.
That's right.
So, on that note today, I think the topic is infinite revenue?
No, not infinite revenue.
Infinite revenue. That sounds
infinite
good.
return.
Infinite return. I'd kind of like infinite revenue as well.
Infinite revenue. Yeah, well, if you have infinite return, that's kind of the same thing.
Well, why don't you tell us, what do you mean, or what do you think when you think infinite return? We're going to talk about money.
Yeah, so this is really about money, and so you've heard of return on investment.
Yep, ROI.
ROI. And so for those that don't know what return on investment is, so let's say you put $10,000 into an investment, like into real estate, into stocks, into a small business. What other things could they do?
Oh dear, cryptocurrency, anything that has any sort of a value,
right?
That you're investing in,
right? So if you were to have that $10,000, like a year later, you still had that $10,000, but it kicked off 1,000, right? That would be a 10%
return on investment, right? Because the investment is the money you put into that to create the hopeful return.
Right. Okay. And so when you take that $1,000 and divide it by 10,000, it's 10%.
Yep.
So that's where 10% return on investment
ROI.
And then you look at it from a year standpoint. So you can measure that from year to year. So you have 10% return on an annual basis, right? So that's return on investment. Now another one is return on equity.
Right.
I've
talked about that.
So the difference between investment and equity. Investment is the money you put in, but equity is the value you have in that investment or that asset.
So let's do that with like a house. You you buy the house, you've got a mortgage on it, say for $100,000, But the market says, when you go and do a comparative market analysis, that house is now worth $250,000, right? So you now have 250 minus the $100,000 or 150,000 in equity, right?
Yeah.
Is that equity real?
Yeah.
It is.
It's real in the terms of equity, right? You don't I guess you don't realize it.
So maybe
Until you
maybe the
sold.
better question is, can that equity change? Can it fluctuate?
Yeah.
Okay.
Like-
So the market
like-
changes.
Like my vehicle, when I put
Yeah,
when
there
I
you
put
go.
gas in it, the value of the vehicle goes up.
All right. Not sure that's exactly the same.
Okay. But so it's the equity, and so sometimes you can actually do an investment. You buy into an investment and it has equity there. So you buy
Already.
equity. Yeah. So like, so if you have a house.
Give your example of the apartment. I think.
Well, we'll get to
Okay,
that because
okay.
that's different.
All right.
But if you buy a house, let's say you buy, and you've seen those "We Buy Houses" signs on the
Ugly
side.
houses. We buy ugly
Well,
houses.
yeah, we don't want to give them advertisement because that's a
Oh,
trademark.
that's true. Sorry.
But there's you've seen the signs on the side of the street says "We Buy Houses" or "We" whatever it
Yep,
is, right? You see
yep.
those yellow signs, white signs. Those people, those investors, they'll buy a house that somebody doesn't want, right? And so the house might be worth $100,000, but those people are selling the house for $50. So if you buy the house for $50 and you put $10,000 down, that means you're borrowing 40, you're putting 10, but it's still worth 100. So now you have, not only do you have your 10 that you bought, but you have the additional 50 that wasn't part of the
Realized,
purchase,
yeah.
right?
Right.
So the
Right.
market says it's 100, right? So you just put 10, so now it's like $60,000 in equity. And if you got $1,000 in the year off that property, your return on investment is still 10%, but your return on equity is much lower, right? Because now
Right.
you're comparing it for 1,000 over 60.
Right.
Right, so it's much lower. So that return on equity is an important value as well.
Yeah.
So how does something like that? What if you could get your investment out, right? In that situation where you have to buy a house for $100,000 or $100,000 house, you buy it for 50, you put 10 in there. So what you put in there is only 10. But if you refinance it after, sometimes they're not financeable when you get them like that at that shape. But let's say you do some work on it, just not slave labor, but sweat equity.
Sweat equity, right.
You do the work. You don't
Yep.
have to put a whole bunch of money. You just maybe it's cosmetic type stuff, painting, fix a sink.
Yeah.
Get it workable. And now it's worth it. You can refinance it because the bank looks at it and says, yeah, it's worth. It was $100,000. Let's give you 80% loan. So they're going to give you $80,000 to refinance it. Pays out that first 40 that you had, pays you back your 10, right? And then there's an extra 30 in there that they put in your pocket, right?
Right.
So you're pulling equity out, right? But let's take a look at the 10,000 that you put in there. So if you put 10,000 in there, and you just pulled out 30. What's the return on that investment?
Yeah.
30,
200%.
300%?
300%. Yeah.
Yeah. So that's cool, right? But that's that first year that you did that refinance. What is the return on an investment the second year?
Well, if you're renting it, is that what you mean?
Yeah.
Yeah. So if you're renting it, you're going to get whatever cash flow in there outside of paying for the mortgage
Right.
on it.
So it could be that, right?
Mhm.
But your investment was 10, but then you pulled out the 10, right, with that 30.
All right. So this is all fine and good. But now some kind of a market collapse happens. I don't know. A virus hits the world and
Right.
all the market collapses.
Yeah.
And you've got that $80,000 loan on that house, but the house all of a sudden in a matter of 6 months drops to a value of $40,000. What happened to all that return on equity now?
Well, you
still got your,
so there's
you took your money.
Yeah, there's no equity now, right? But what we wanted, so there is no, you wouldn't have a return on equity, right?
You're still on the note though.
Yeah, so you're.
That's what I'm asking. You're still on that note, right?
Yep.
You're still exposed to that mortgage that's there.
So you'd be considered underwater, right?
Right.
But when you buy a rental property, and we're leaving the topic, and we're going across, the scenario you just painted is going to force us to leave this topic. And we're going into why you would buy an investment in the first place. And then you buy the investment in the first place, and that would be, you would buy it for the cash flow. So you'd be buying it correctly.
Okay.
Versus just going out there blindly buying it. So just don't blindly. The illustration of why we want to talk about infinite return is to talk about what is infinite return, right? So we talk about return on investment, return on equity, but when you pulled out your initial investment and you're still getting cash flow on that rental, then what is that money? What are you comparing it against? You already pulled your investment out, right? So you're actually taking whatever gain you had on the cash flow, whatever, thinking $200 a month, $300 a month, whatever, 50 cents a month, whatever that is, that money, what do you divide it by now if your investment is out?
Well, it's
zero,
100%.
Right?
Yeah.
So you can't do zero. So therefore, it must be an infinite return.
I got you. Yeah.
Right. So that's
where that passive income is.
There's different things so passive income is you're not really working. You're not trading your hours for money, right?
Yeah.
But looking at returns, you can, people talk about return on investment. Oh, I get 10%, or I get cap rate. Those are returns, cash on cash, returns. But there is a thing that they call infinite return. And so what is infinite return? Infinite return is after you've pulled out your initial investment out, right? So I have a really good friend that wrote a fantastic book.
What was his name?
Steve Wastenberg.
Oh dear. What was the name of that book?
Trading on the House.
Yeah, so
right?
That's an illustration, frankly.
It is. And so
when
when I hear the term trading on the house, I think of when people go to Vegas.
Yeah.
And they win and they go, oh, it's just house money.
Yeah.
Right? And that's the same concept when they go into a casino and they play blackjack with machines or whatever, and they put $20 in, $30 in, and they win $100. They take that 20 and $30, they stick it in a different pocket, and then they got
they're playing
$50, $60, right?
Right.
That's house money. Then they spend their weekend playing house money.
Yeah.
Right? That is kind of infinite return because they've got their investment back and it's in their pocket. They're not going to use it.
They're enjoying the proceeds in their gambling, and maybe they make more, maybe they don't.
Right. With the book that you wrote, you talk about buying a stock, having that initial investment. It's 100% investment when you buy the stock. Right.
And you're exposed.
Most people don't go into the margin stuff when they're not taking out loans to buy stocks. Most people don't. There are some people that are strong about a certain play and they'll do that, risky. Mm-hmm. But for most people, they take $100 a week or $1,000 a month, whatever their income level is, and they're going to invest it. It might be through their 401k or whatever. They're taking that portion there, but it's 100% investment. And so if it's a dividend stock, there's some cash flow there every quarter or annual, whatever that thing is. So they might get $1 off that stock. Maybe it's per stock. If they have 100 shares, they get $100 and they put $1,000 in there, so they get, what is that, 1%?
Yeah.
So they get so there's a return on investment there.
But that's the key. It's return on investment, because their investment capital is still exposed to the risk of that stock dropping to the basement.
right. So they still have their investment in
Right.
that asset that they bought.
And would you agree, most people, unless they're day trading and flipping for a profit, most people are willing to take that risk over a period of many years, but they're always exposed to the risks of a market massive downturn.
Yeah, it goes up and down, right? And we should say their hard-earned cash
Yes.
is exposed.
Yes.
Right? Because when you, in your book, you talk about when you buy a stock, and that's to set a trigger point where the stock goes onto a certain gain, right? Then when you hit that trigger point, you sell not all the stock, but enough to return your initial investment.
Exactly.
Right? So there should be that portion, and it truly is like the equity when you look at gained equity.
Right.
Right? That portion still is an asset, right? But you pulled your initial investment out, right? Now, especially if it's one of those stocks that pays a dividend,
Oh yeah.
then you've got
it's
some
beautiful.
serious infinite return on that investment.
Overstock.com. Oh my Lord, I've got one of those as one of the ones of my real properties where I invested in it, pulled my capital out, and now it's a real property, meaning I don't have any of my capital in it invested. It's all the profit in there.
Right.
That stock goes up and down, it fluctuates, but it flipped off a dividend and it flipped off preferred shares based on how many shares I had.
Right.
So now I have another set of
wow.
shares on that is at 300% gain.
Right.
It's a small amount of shares, but think of the way that works when you talk about infinite return. And guess what you do with that investment capital that you pulled out?
Right.
You go on the hunt for another
Right.
stock out there to buy, to get to a gain, pull your capital out, and rinse and repeat over and over.
Yeah.
Right?
So-
You did that as well, though, with
Real estate.
real estate.
Yeah,
How does that work?
So, one of my investments is to be part of a syndication that purchased an apartment complex.
Okay.
So I invested in that group, and that group went out and bought an apartment complex, and after 3.5 years, 4 years, we refinanced the complex because the value of the complex rose. We managed it so that the rents were market rents and managing tenants, and so we were able to refinance and improve the value of that property. When we refinanced, all the investors were able to pull their initial investment out, and we still have that property, and that property produces the cash flow for each of the investors, right? So our money is our hard-earned money that we went to work for and saved is no longer in that investment, right? So it's purely a return, an infinite return, because I have no hard-earned money in there. And I hope people are understanding that when I say hard money earned, that's the hard money is when you are working hard to earn it.
Right.
And it's not.
It's a trade-off between your time and your money.
Right.
Right?
Right. Now there's people can come up with different aspects of how you look at that, but the point of infinite return is when you take that initial investment and you're able to pull that initial investment and still own the asset, and you look at what was my initial investment, and it's not the same as if someone were to have an initial investment and they do the cash flow, and that cash flow is like 1,000% because over time. Because technically, I guess you could say I pulled my initial investment out at that point. That's not the same.
Because your initial, that begs the question, when you pulled that out, what did you do with that investment now? With that investment
it's
capital?
invested in something else.
Now you go and take that, and it becomes the engine to go and get another group together to do another apartment or another real estate
Right.
deal, or in my case, another stock. And so you continue to grow that.
Right. But when you get into that infinite return situation, the best way to look at it is if you're in an infinite return is if you were able to compress time and pull that investment out sooner than as if it naturally gained
I got you.
return over time.
No, I totally agree. Which is what most people do. Most people would turn around and argue this and say, well, I long-term invest, let's say in the stock market.
Right.
I put my money in every single month, and 30 years from now, I will have all of this gain on that. Yes, you will, but none of that money that you're putting in there is doing something with something else, is creating a new thing. You're just dumping it into this one and frankly making a long bet.
Right.
Maybe it's a conservative long bet, but it's a long bet.
Right.
Whereas if you can, even if it's a small amount, whether it's real estate or otherwise, pulling that out and then going after another, pulling it out and going after another, you're constantly taking this, what I like to call the engine of your capital, and making that engine work for you, which is making money work for you as opposed to working for the money.
Right. Right. Yep. So that is a pretty deep.
Yeah,
topic
I
and
hope
coverage
that
on
it
a
wasn't
bunch of
too much analysis and stuff, but it's a really interesting concept to get this down and to really look at, instead of just passively saying, "Oh, my money will someday, someday I'll be fine."
Right.
Taking an active case in it, and of course, talk to Steve. He's a coach. He can do all kinds of things with you in the real estate world and that. And my book is out there as well, Trading on the House. You can go and get that, but you got to get out there, regardless of whether or not you do anything we say. I mean, in terms of what we do and work with us, get out there.
Well, before we close up, we talk about real estate. Real estate's can be tough to get into if you don't have the right training, right? With stock, is you still need to get training, but it's not as tough to get into,
It's
right?
absolutely
So someone
right.
can start trading with stock with, $10, $25, just picking up one at a time type of thing.
I have, and children, and they've read the book, and they're working on a mastermind that we have with, and they are have been successful right out of the gate in terms of getting real small positions.
Yeah.
But they're training themselves to
That's right.
think differently about money and think about it as, this is my investment capital. How can it create something and continue to create something, as opposed to just stick it in it's basically a savings account.
Right.
If you just stick it there.
Right.
Put your head in the sand and put it in the sand. So you're absolutely right. You can start very small.
Yep.
Very
and
small.
that's what I wanted people to encourage. Is I'll talk about real estate all day long, and people can start with real estate with almost nothing, but you got to get trained to figure out how to do that.
Yeah.
And people do it all day long, all over the country, all over the world. Really, they do things like that. But you have to really know what you're doing, and it takes some effort and time. With stock, it's not as, you still need to get trained. You need to understand what you're getting into and understand that asset a little bit. But you certainly can do that within a short period of time and get into that and start building assets and start learning about how to get infinite return pretty darn quick.
Barrier to entry is real small. Very basically very limited.
All right,
Great.
Steve, this is a good topic.
This was, and we drank water today.
That's
so
right.
back to the water bottle.
Enjoy.